Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
Well, welcome back. Another fine week. And man, have we been busy. Holy cow. Department of Labor gets involved in managing retirement plans. And part of the retirement plans are our IRAs. Those are considered retirement plans. And since a lot of money rolls out of normal pension plans and 401k plans, state plans, SCRS, STRS, they included IRAs in that number, in that group. And they've made a lot of changes. A lot of changes. And complying with it is not optional. It's mandatory for investment advisors. Some changes. There are going to be some slight changes for us. We've been working really hard on it. And I think I look at this and I think it's a good thing. However, they're missing the target that they're aiming for. And I won't go into too much detail about that. All I can tell you is that if you have an IRA and you're working with an advisor, things are going to change a little bit, not necessarily in a bad way. I look at the changes and I think, yeah, okay, that is an improvement over what the vast majority of people are doing. So it's pretty cool. We'll be talking about that in detail for the next year or so because everybody has to convert over to this. And it's not going to be an easy process. It's not going to be overnight. You're going to have to work more closely with your financial advisors. All my clients are going to have to hear from me either on the phone meeting, computer meeting, or in person. One or the other, and we'll be talking about the changes that are coming down and what we're going to do about it. And quite frankly, I think it's probably a good thing. And here's why I think it's a good thing. International emerging markets, stock markets, have not done nearly as well as the S&P 500 has over the past 5 years. Past 5 years, our stock market has crushed theirs. I mean, there's no comparison. However, that doesn't always work that way, and sooner or later, the pendulum's going to swing back the other way, and you'll wish that you'd have some of your money invested in those things, and that's what the part of the DOL rules are recommending, is that you add those categories, and I think it's a good idea, and one of the few times in history where government's ever passed a law that actually helped just almost about everybody. So it's very interesting. And incidentally, the reason I left the brokerage business, or I was an RIA before I left there. An RIA is a registered investment advisor. That means you can operate on discretion, but you also have to operate in your client's best interest. So when I left the brokerage business, it was because I wanted to be on the side of the client no matter what. And that's what I wanted to do. I didn't want to have a conflict of interest anymore. Was tired of it. Was willing to take a massive pay cut and invest a significant portion of my personal net worth into building a business that way. And so now what they are doing is they're requiring that everybody operate that way if you are managing an IRA. If the money is not in an IRA, if it's a taxable account, you can still do whatever you want. If you are at Merrill Lynch or Payne Weber, you can do whatever you want. Be it UBS, you can invest in anything there. If you're with an investment advisory firm and we're making investments, there are a lot of things that we have to stay away from that you could invest in other places because they're not considered prudent. So as a registered investment advisor, you have to stay prudent. It's one of the reasons I put up the Lookout for the Bull website, because there is a strategy that works reasonably well as long as you stick to the rules. And there's no classification for that in the Department of Labor's new rules. There's none. And I call it trend following. A lot of people call it trend following. In fact, there are large numbers of people that have been very successful over the years doing that. But that's why I put up the website, Look Out for the Bull, because I can't really do that for anybody anymore. The rules are too restrictive. There's no way of classifying that stuff, and the risk to my firm is too high to do something like that. So I put up the subscription website. So if you were still interested in that, you wanted to know exactly how it works, you can sign up for it. It's $20 a month. You can quit anytime you want. You get to take it long enough to figure out how to do it on your own, and then you don't have to subscribe anymore. How's that? For being fair. And anyway, so I put that website up. And having mentioned that, I should come back and also mention the seminar we have coming up. It's going to be July 22nd. That's a Saturday morning, 8:30 to 10 o'clock. Corporate College. Same bat channel, same bat place. Different time. It's a Saturday morning, 8:30. You can go to my website, bullingtoncapital.com, click on the seminars link. It'll tell you about it. And the topic's actually going to be showcasing some new technology. They're going to help you stay on track of your investments and financial plans. And we've tried to roll this out several times in the past, and the services, quite frankly, just weren't ready for prime time. The links to financial institutions were constantly breaking. Fixing them was very difficult. This is it's improved significantly over the past. I knew they'd get it eventually. So we're going to talk about that. We're adding that as a service to clients. That again is a slow process because the software is very complex. It's easy for the individuals to work with once you get it. Well, I shouldn't say that. It depends on your level of skill with the PC, by the way. And we're going to have to provide support on that. Actually, we're not going to have to. We're going to provide support on that for our clients. So you can look for that shortly. I'll be sending out emails to all clients explaining it. And it's pretty cool. So we're going to be showcasing what we know so far at that seminar. I think it's pretty awesome. I use two custodians in my firm. One of them is called Folio Institutional. The other is called Fidelity Investments. You may have heard of them, especially Fidelity. We can bring in the accounts from both of those firms into one place so that you can see it online in one place instead of having to go to two different websites. You can still go to the two different websites. That's always going to be there. But if you want to see everything in one place, you can do that. You can enter in a whole bunch of other stuff that only you can see. You can put in all kinds of things in there. You can do a budget if you'd like to. You can actually monitor your spending. This is what I like about it. I put my credit cards on there, and they're updated. If I see a transaction that I don't recognize, I go right to the credit card website, look it up, and if I still don't recognize it, I can call the credit card company. How cool is that? Anyway, so we're going to be talking about that, showcasing that at that workshop. Again, you can go to my website, bullingtoncapital.com. It's available for free. We have 90 seats available out of 100. And it's a Saturday morning. We'll get you in and out pretty quickly. They will have a continental breakfast. There's no cost to attend. I do tell some pretty corny jokes. You'll have to endure that. That's your price of admission. But anyway, so you can go to bullingtoncapital.com and sign up for that online. Hey, if you'd like to call us today, the number is 216-901-0945, 216-901-0945. And I'm sitting through this class, by the way. If you go to my website, you're going to notice something a little bit different. Next to my name are these three letters, AIF, trademark. That stands for Accredited Investment Fiduciary. See, to get ready for this Department of Labor rule change that's going to affect me and everybody else in the country, I decided to take a class and become accredited investment fiduciary. The company is FI 360. It's basically you're taking an oath. They do a background check. You study for this course, saying that you'll put your client's interests in front of your own. That's part of the pledge that you take. That's part of what they teach in the course, and then they teach you how to do that, how to research. I have a Bloomberg terminal, which I'm questioning whether or not I should keep, by the way. But there are 60,000 some odd securities. You add stocks, bonds, cash, or not cash, money markets. That's equivalent of cash. mutual funds, variable annuity accounts, about 60,000. I think it was the actual number was 67,000 I saw last time I looked through there. That's a mind-numbing number of options that you have to invest in. So part of what the program was doing was teaching prudent investment principles. Like how do you select a fund? Let's say you want a large company stock fund because you do your asset allocation questionnaire and it comes back and the recommendation is that you've got 30% of your money in large cap stocks, large companies based in the United States. That's what it comes. That's the answer. That's the government approved answer that comes back. So how do you know which of those 60,000 some odd securities qualify? And then how do you know which ones are the better ones? Yeah, it's a lot of work. It's really the bottom line. It's a lot of work because you're going to go through it. And I will tell you this, 19 out of 20 people think that price, how much it costs, and performance are the two most important things. And when I say that, I can see people listening to the show, driving in their car, just nodding their heads going, yeah, well, that's not it. I hate to break it to you. Actually, I don't hate breaking it to you. You need to know this, that if that's all you know, you get to join the 19 out of 20 people who would be much better off just buying a regular old balanced fund and never looking at it. Okay. That beats 19 out of 20 of you. Think about that for a second. 19 out of 20 people would be better off in a regular old balanced fund. Now, and here's the rub. In the performance and pricing is important. They're not the most important thing. You really need to know what the fund is doing to generate those returns. You need to know more than a 1, 3, and 5 year track record. You've got to know a lot more than that. Why? Well, because if that's all you know, you're going to be constantly buying the funds that have just gone up the most because a 1 year track record is going to lift the 3 and 5 year average. And when some fund manager somewhere who took an enormous amount of risk and got lucky, it comes to the top of the list, you're going to invest in that. And when then his luck runs out and you lose a lot of money with it, and then it puts you in the bottom 10% of those funds in all categories, you're going to go, wow, what happened? And you'll try that again. And that, by the way, is exactly what goes on. And incidentally, it's one of the sales techniques salespeople have a tendency to use. Let's find the 1, 3, 5 year track records that have got the best returns. Now, the next thing a commission salesperson looks for is, okay, now which one of these pays the highest commission? That's what they want to know. Let's give the biggest returns. And you know how I know this, by the way? Because I came up through that system. I know that that's what they were doing because that's what was recommended to me when I was young, a long time ago. And you know what? Yeah, people will buy that. I promise you. They buy that every day. Give me the biggest track record, and here's part of the pitch. Well, even if it does half as well in the future, how much better off will you be? And see, the problem is it's probably not doing half as well as it did. It's probably going negative because of the risk that they had to take to make it into the top 1% in any one given year. So how do you avoid that? What's the answer? Well, the answer is actually you have to look into how that fund is being managed. You have to look at the top holdings in that fund, in those funds. You've got to look at the people who are running the fund. How long have they been there? Is it done by an individual or is it done by a group? My preference is to have the group. In some cases, by the way, you think there's an individual manager because their name is on the prospectus. And in fact, there are multiple helpers with that fund, and that's an important thing to know. The lead portfolio manager will typically make the most important decisions, but if they typically have a support staff. My preference is to management committees, a fund that's run by a committee, because it avoids the all-star phenomenon. You get an all-star fund manager, and occasionally something goes wrong. They end up going through a divorce, and suddenly they're not thinking clearly, and they make mistakes. That's I'm laughing about that, and not because I made it up, because I've actually seen that happen. Okay. Somebody goes through a rough period in their life that has nothing to do with the stock market, and suddenly they're not thinking as clearly managing this money, and the performance starts to drop or even crashes. So that's why I'd prefer a committee running the fund. Looking at the top holdings, looking at the amount of turnover they've had in there, looking at the style of strategy, that's important stuff. You need to know that. And I don't think I've never been approached by somebody who could answer those questions. How many people run the fund? Do you know who they are? Do you know how they pick stocks? I've never met anybody that could answer those questions in all my years doing this for a living. And it's probably because the people that know to do that aren't seeking help. That's probably why. But it's a lot of work. Now, and it cracks me up. I get people all the time. Can you take a look at this fund for me? You know how long it takes to do the research on that? Yeah. If you're really doing the research on that, yeah, you've got several hours invested. If you're doing the real research, okay. So now think about this. When you've asked somebody else about a fund, hey, could you look at this fund for me? And they spit out an answer right away. What do you think they're doing? Yeah. They're not doing the research, I can tell you that for sure. Because it takes quite a while, unless they happen to know, like, and invest in that fund. What are the chances of that? 1 in 60,000. Those are the chances. So when you're asking somebody to do, and by the way, people ask me this all the time. They have no idea how much they're asking me to do. And most of the time the answer is no, I can't. I can't. If I were to have to spend the kind of time it takes to really thoroughly research that fund, for everybody that wanted me to do it for free, by the way, I would never be able to get my work done. And it takes a long time to do that kind of stuff. You're analyzing a fund. It's harder than analyzing a stock. A stock is 10 times easier than analyzing a mutual fund, which I know is counterintuitive to what everybody thinks. They think a fund should be easier, and it's not. Yeah, it's significantly more difficult. You're in a fund that invests in, let's say, master limited partnerships, for example, and all you know is performance, and those things got the snot beat out of them when the market was correcting over the past couple of years. You would think that the portfolio manager is not doing his job. No. Portfolio manager has been doing a great job. It's just that the industry has not been doing very well. Anyway, we'll finish that thought and other thoughts when we come back from these commercial messages. This is Bill Bullington right here on 1420. Stay tuned. And we're back. Hey, I got a call earlier in the week last week from a guy who wanted to learn about stocks. Is there a good book you can recommend? And actually, I was kind of at a loss because most of the books that have been written that were really good, they were written a long time ago. Most of them are out of print, and they're 600 to 800 pages. So those are the really good if you want to get down and dirty. Some of the accounting rules have changed since those books were written as well, which is not that big of a deal. But I think the probably the better books, if you're interested, are the ones that Peter Lynch wrote in 89 and 90. That's a long time ago, too. I think those do a much better job of just giving you an idea of what it's really like to invest in stocks and just how unpredictable stocks can be. And I know the average person doesn't want to hear that. The average person does not want to hear that stocks are unpredictable. The average person is looking for certainty. That's why the average investor does not do very well in the stock market. In fact, they do extremely poorly on average. If you're not doing extremely poorly, then you're above average. But the reality is stocks are pretty volatile. They're extremely volatile. Their prices fluctuate a whole lot faster than the business values of those businesses if they were actually to be sold or purchased by a reasonable investor. What's a reasonable investor? Maybe a private equity firm. The prices move way faster than those values actually fluctuate. And that's the first thing that confounds somebody who's relatively new to the stock market. You have to put up with that. You have to learn how to put up with that. It's not going to change for you, but that's okay. You can find out how it works and then try to stick with it, develop a philosophy. It's one of the reasons that funds are just so popular. Funds are popular because it takes away a lot of the decision making that you have to make if you're running your own money. I still like to do individual stocks. I'm still going to do individual stocks. I have a certain portion of my money. I think that's probably the right way of approaching it. Having a plan. We'll talk about all those things in a couple of seconds, but I got a really quick call from John. John, you have a question for us?
Yes, good morning. I understand that the fiduciary rule, or at least a watered-down version of it, is scheduled to go into effect in June. Is that true? Or
that's what I heard. Yeah, that's exactly what I heard.
Okay. Did you know if it is different than what they originally proposed, or is it?
Yes, and it's probably going to change before they actually pass it.
Okay, and this applies only to retirement investments?
Well, it applies to IRAs and pension plans, 401k plans. It does not apply to a regular taxable brokerage account, like a joint account.
And what's the resistance in the financial industry to the implementation of this rule?
Everybody that I know of, the bigger firms, they've all been trying to figure out how to comply with it, and most of them feel like they've probably got a decent handle on it right now. It'd be interesting to see what the implementation looks like from firm to firm. It's one of the reasons that I went to the AIF, got the AIF designation, just trying to prepare. And we have to make a few minor changes because I've been doing this for a long time. I always put my clients' interests first. When I left the brokerage firm, I actually started doing it before I left there, which didn't make me that popular, by the way, and it cut my income down fairly significantly. But I just felt like it was the better way to run your business. But we don't really know a lot. We know that this thing has been changed, that there are big sections of it that are probably going to change even more so. By the time it is enacted, it'll be amended from time to time. So, it's nothing is as constant as change, I guess. But
you think it's gonna happen, and it's gonna stay with us then going forward?
Yeah, and I'll tell you what's happened. There are a lot of products in IRAs in particular, especially that are sold to older people. The fees are so expensive. Like a lot of equity indexed annuities, the carrying costs on the products that they're using inside of those products, okay, are minimally 10% a year. That's the carrying cost. They're not disclosing that because they don't have to, because you can't actually predict what that is. Okay? And that conversation goes way beyond anything I could ever explain on the radio in an hour. Okay? But I can tell you that the costs are real, that people are putting money into those things, and then they're dying 10 years, 15 years later, and the money that's left is less than they had started investing with. Okay, that's what the real problem is. And by the way, the Department of Labor rule is missing them completely. They missed. The laws were set up to try to stop that stuff from happening, and the people that are doing that are not in the brokerage community. They're insurance salespeople. There's no federal Department of Insurance that's governing that's watching these products. They're saying these are not securities products, although they're investing in securities. And they're investing in the most highest risk securities you can. Futures and options on futures. They're using that to hedge. The hedging cost is enormous. The insurance cost, if I were to buy say SPY, and then I buy a put on SPY, go and look at that. Go to yahoo.com. I don't say anything on this show that you can't research, and if you don't know how to do it, I'll tell you how to research it. Go to yahoo.com, pull up SPY, and then pull up options on that will give you the insurance to guarantee that you can sell it at a certain price over a certain amount of time. Figure out what the cost is, and you will see exactly what I'm talking about. It's 10 to 15% per year. That's the insurance costs. What is the long-term average of the stock market?
10%.
Right. How do you make any money?
You don't?
Exactly. Well, you can get lucky because they're doing that on a monthly basis, and occasionally you get a big upward month, and you might make a little bit of money. But in the long run, you are not going to make much money. And that's what they were trying to get after, because people they invest in these products because they guarantee your principal. Can't lose more than can't get back less than put in. Yeah, but you have to live long enough for that thing to hopefully make a little bit of money at some point in time. And by the way, those are just the new products. The products that were issued 10, 15 years ago, they're not making any money today, but they did make some money up until that time because the insurance costs were significantly lower back then. The premiums that you'd pay were a lot less. Okay, so but those days are gone, and those have been the biggest sellers to retirees. And this Department of Labor rule that was aimed kind of at that. So it was really aimed at pension funds too, because you get a lot of private equity firms and hedge funds in there that were charging 4% of the principal and 40% of the profit. You know, those days are gone. They will never get that again. But a bigger part of it, a big part of it was also these equity indexed annuities, where people they're in these products for 5, 6, 7 years, and if they pull the money out, they're going to get back a lot less than they'd invested with. So not only are they losing a chunk of their principal, all that time goes by, and you can never get that back. And the returns that should have come with that are gone too. So it's really been hurting the IRS, because they're collecting a lot less tax revenue because the money's going to pay for insurance fees and management fees instead of the returns that the clients should be getting, who would end up paying a taxes at least on a portion of that money. So everybody's losing except for the insurance companies selling those products. Now, not all the insurance companies are bad, and not all those products are bad. There are actually some pretty good ones out there, but there are a lot of bad players, and they missed those guys with these laws. Now, at some point in time, what I'm hoping is that they pull those contracts, they single those out and pull them in under FINRA or under the SEC, and once they do that, then they'll have some way of actually stopping, that stuff from happening, because that is rampant. That's one of the bigger scams I think that's going on in the general public, and I call it a scam. If you're an insurance company, a lawyer, sue me. Give it a shot. Because I'm really I'm tired of it. You got to be very careful out there today. Read your contracts, and by the way, they're written by Philadelphia lawyers, and the only lawyers I know are from Cleveland. But you got me on one of those things where it's upsetting to see what's happened in that industry. It started off as a really good idea. The insurance costs were reasonable. Today, it just doesn't exist that way anymore.
Right. And the average consumer has no idea.
None. Most of the people selling the products don't have any idea. But I can tell you what they do know. They do know what the commission is on it.
Yeah,
which they don't. They were supposed to disclose that, by the way. I've seen so many proposals by my clients. They send them in, and what do you think of this? And they're missing the commission portion of the disclosure on the proposals that I've been looking at, which that's a good way to lose your license, like lickety split. But anyway, so they're shooting for those guys too. But the Department of Labor rule kind of missed on that one, because those products today are not classified as securities; they're classified as insurance products. So, right. And there are some pretty good ones. There's some no load. There's some one firm has a $20 a month. That's their total admin fees, $20. It's basically just for tax deferral, which is a big deal. Tax deferral is a huge deal. So they charge $20 a month for their admin. There are no death benefits or anything like that. It's just for tax deferral. To me, that's a great idea. You got money in a taxable account. You want to manage that money. You don't want to be just buying stuff and holding it forever, because your risk gets too high. You'll get overweighted in something. Then when it comes down 30 or 40%, you got a big whopping loss in that account, at least temporarily. So you want to be able to rebalance a portfolio, but most people aren't doing that because they don't want to deal with the taxes that would be involved. That tax deferral is a big deal, can be a big deal, but you don't want to pay too much for it. And so there are good products out there. There are bad products. You just have to be really, really careful.
Okay. All right, Bill, listen, I appreciate your insight.
Hey, thanks for calling. Have a good day. Yep. Yeah, just got to be careful. No matter what you're doing, you got to be careful. Try to do the best you can. Try to find out, what you're investing in. If it sounds too complicated, my suggestion is walk away. If it sounds too complicated, you don't understand it, and the advisor that you're dealing with can't explain it in language that you can understand, walk away. There's no shame in that. Heck, it happens to me all the time. People ask me a question, not expecting me to answer the whole question. And the next thing we know, the heads are swimming because there's a lot of detail out there. There's a lot of knowledge that needs to be acquired, even just to understand the answers to the questions. So if you don't get it, either keep trying or just walk away. Find some, or you can always find something, by the way, that you can understand. There's no way today, with all those products out there, you can find something that you can understand. Not that hard. That's one of the reasons I like the simpler models. They are easier to understand. And also understand that when you're investing, another thing that people do constantly, they'll pull up Russell 1000 or 3000 and say, well, look at this. Yeah, it's the best performing category over the past 5 years. You're comparing yourself to the best performing category over the next 5 years. What happens when small caps come back to the top again, which they will one day? And you'll be making the same mistakes. Why weren't we in that? You see, the answer is you have to hold some of that along with the large cap. And yes, that means you're always going to have something in something that's not performing quite as well as the one that is performing the best. But unless you've got a crystal ball that works, those are your choices. You can keep trying and changing after the fact. And by the way, it is incredibly difficult to understand when something that you're doing is broken. Maybe it's never going to work that way again, or it's just going through a period of underperformance. It is incredibly difficult to know that. Yeah. In fact, the market will make you seem like you're pretty dumb for an extremely long time period from time to time. Now, if the ideas really have merit, eventually they should come back in vogue and you'll be rewarded. But you can't guarantee any of that. You just can't. So again, you just have to try to do the best you can. And if you're looking at funds, to invest in, a 1, 3, and 5 year track record's okay, but you need to know more than that. I like to look at the 1, 3, 5 year track records. I like to look at 10-year track record if they have them. By the way, the newer funds have a tendency to do better than the older funds. Why? Because they're smaller and more nimble. Pretty simple, right? Extremely simple. When that fund's been around over 5 years and it's a small cap fund, it's not a small cap fund anymore. If they've done very well, that's a mid and large cap fund because there aren't that many small cap stocks for them to invest in. Yeah, that's something you probably don't know. I hear that all the time. And people constantly, well, why does that matter? Well, because it does. You don't have to believe me. You can experience it yourself. Experience is the best teacher, by the way. I like to learn from other people's experiences as much as I can because I won't live long enough to have all the experiences on my own. Neither will you. So looking at that, watching it, having been around through multiple market cycles is a big edge. It's a huge edge. You see things. You experience things. Got tools today that have improved dramatically. Used to just look for the best performing in each category. Then you'd have to go up and pull up the holdings in each and every one of them. Well, that was a long, time-consuming process. And I'm going to talk a little bit about how we can make that a lot quicker as soon as we come back from these commercial messages. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned. And we're back. Hey, before we continue with the show, I just thought I would again remind everybody, we got a seminar coming up. It's Saturday morning. What does your financial future look like? We're going to be showcasing new technologies to help you stay on track with your investments and financial plans. This is pretty exciting. We've been working with this company on and off for about 5 years, actually maybe a little bit longer than that. But the technology was never quite ready for prime time. It wasn't ready to roll out on a large basis without having a significant support staff behind it. And like most other things in technology, it's been improving, and we're ready to give it a for real rollout. What does this stuff do? Well, it allows you to pull in your accounts to see everything in one page. You can see how your assets are allocated. You can pull up your statements. You can add a whole bunch of stuff to it. You can add the value of your home. You have a business you want to add to it. You can put papers up there, tax returns, stuff for your accountants. It's got a ton of stuff on it. We're calling it a financial dashboard, which is not my term, by the way. It's the term that's been bannered around the industry. And it's really cool. You can really keep tabs on just about everything that you're doing in one place. Now, we're only able to set up for clients and see what we manage, but they can set up anything else that they want to. You can track like I said, you can track your spending budgets, value of collectibles. You can keep insurance documents there so you don't lose them. I think that's a great idea, by the way. Any important documents you have, there's a secure vault, digital vault that comes as part of that service. So we're going to be rolling this out to clients. If you're hearing this and you're a client, don't panic. We're getting to you as fast as we can. We're setting these up now. The emails will start to go out by the end of next week to let you know that that service is going to be available. And I'm really excited about it. It's something I think is really necessary today because it's so difficult. And that's the difficult part about investing, by the way. It's not that the investing is so hard. It is challenging. That's for sure. But it takes so much time. I mean, it's unreal the number of investment options that have become available. I can't believe it. It's multiplied way more than than stocks have. There aren't as many stocks as there were when I started in the business, but the funds that invest in them have grown by tenfold. So it's a lot of effort. A lot of effort to keep tabs on all that stuff, and that's kind of what we're going to be talking about. How do you keep tabs on it? What are the right things that you should do if you're going to be a mutual fund investor? What should you know about the fund? I'm going to pull the curtains back and show you the wizard. These are all the things that you should look at, and I just think it's an exciting time. I think for a lot of people. If I were a young person, I'd be really excited about it. Don't get caught up in all this doom and gloom, and you know what's really happening with the Trump administration? Businesses are investing in new projects faster than they have in the past 5 years. Businesses are investing in new projects. Past 7 to 8 years, instead of investing in new projects, the vast majority of them have been buying back their own shares, which drives their earnings up, by the way. That drives the earnings per share. That drives their profits per share up. Okay. But now they're starting to invest in businesses. Good, bad, or indifferent. I don't care what you think about this president. My personal opinion is that they're taking advantage of the fact that they feel like they can progress a little faster without the fear of regulation. I got a phone call coming in. If you'd like to call, the number is 216-901-0945, 216-901-0945. Now, feel free to give us a call there. But again, just to summarize, we'll be talking and showing that technology, talking about that technology and showing the technology at the upcoming workshop. Should be a lot of fun. And I got a phone call right now. Jerry, you got a question for me?
Hey, Bill. Good morning. It's Jerry.
How you doing?
I'm well, thank you. Been following momentum stocks. You got anything new there that you'd like to mention this morning?
Yeah. Take a look at web.com. The symbol is
web.com. That was.
Pardon me?
That was just on.
Yeah. It came up yesterday. Actually, it came up about a month ago, too. It came back up yesterday. That is a classic cup and handle pattern, by the way.
Okay.
That's a classic cup and handle. And
okay.
It was up 8.96% on Friday. And,
wow.
Yeah. And you know who web.com is, right? They just
No.
oh
yeah, absolutely.
Yeah.
I know who it is now. Yes,
Yep.
absolutely.
So, and
So-
in fact, I'll probably, since I mentioned it, I'll put that in the small fund I run on Monday, and I'm going to wait until 10 so everybody has an opportunity to buy it ahead of me.
Okay.
Yeah.
Alrighty.
I have to do that kind of thing, by the way. But if I'm going to mention something like that, but yeah,
That was mentioned on NPR last night, also.
yeah. Now, Jerry, I will tell you, you look too heavily into those types of things, dude. You're never going to be in stocks that long for that kind of stuff to matter. If you're a trend follower, all you need to pay attention to is the trend. The fundamentals, you can forget them. You can just forget them.
Yeah.
Yep.
But the AAOI is still moving.
Yeah. Yep. Absolutely.
I'm astounded. I got out of it at 50, and now it's closing in on 70 again.
I was laughing. I was wondering if you were going to buy it back when it showed up on the scan again at $55. I was thinking, I wonder if Jerry's buying that back. I'm thinking about it as soon as it came up. I was laughing about it because I know you got stopped out because I did too. I wonder if he bought that back. I bought mine back, by the way.
Unfortunately, not. I missed that.
All right,
I
so
missed it. But
you got it.
it's still moving. I mean,
yeah, you got to give up. You got to two things you got to do. First of all, forget the fundamentals. It's not going to matter. Second, because this is trading. This is not investing. Okay.
Correct.
In investing, you look at the only thing you look at is fundamentals. Okay. In trading, you're looking at the trend. Okay. So you look at the trend. The other thing, so fundamentals don't matter. When you get stopped out of a stock and it comes back up on the scan, get used to buying it back. I know that's really hard to do. That's incredible.
It is.
That took me years to get comfortable doing. Now I'll own a stock like 4 or 5 times, and if I'm only profitable on one of those time periods, it's typically enough to offset the losses, and in some cases is enough to make a big profit despite those other losses. But
I'm scared to death that it's going to take a dive. I mean, there's a short.
You shouldn't think that way. I'll tell you this: if you're having thoughts like that, you do not need to be trading. Okay, if you're having those thoughts, you got to stay out. Stocks don't know you own them.
Yeah, that's great. Yes, you're absolute. Stocks do not know you own them.
Yep.
But just the amount of short interest against it is very impressive. I mean, a lot of people are expecting it to go down. And what do they say? A rising stock goes against a wall of worry.
Yeah, and did you see NVIDIA? It's at $141. By the way, the price to sales ratio on that thing's like 15. It's like 4 times higher than AAOI.
Oh wow!
So yeah, that's what I'm saying. It doesn't matter. Stick to the rules. Don't try to be perfect. Try to be profitable.
Yeah. Yes, sir. Okay. Very good. Have a great
have a good weekend.
Yeah, bye now.
Bye. And I got Daryl. How you doing?
Hello, Bill.
What's happening?
Can you hear me now?
I can hear you.
First of all, I wanted to wish you a pleasant holiday weekend.
Oh, thanks.
And as always, you sound great.
Well, that's debatable, but that's okay.
Well, it's an opinion, and I'm entitled to it.
Yep, absolutely. And thanks, I appreciate that.
I got a question that's probably pretty basic, but as a client, and you have the models with Folio that we have some of my assets in.
Sure.
When I have additional funds to add to that, tell me what your thoughts are about putting it in gradually versus as a lump. I think they call that dollar cost averaging.
Yeah, well, I can tell you exactly. I've been thinking about that a lot recently, and unless it's a super large amount of money, I would not. I don't think dollar cost averaging is the way to do that. And I'll give you an example. I had a guy that was dollar cost averaging in, and this actually was a fairly substantial amount of money, and he averaged up over 18 months. We were going a little bit in each month, and the market had been going higher that entire time period. So his average cost was going up, and as soon as he got fully invested, it corrected. It dropped. And
Murphy's Law.
Exactly. So the better idea, I think, is to figure out what your overall allocation is supposed to be. stock? Are you going to be 60-40 stock versus bond? Are you going to be 70-30? Whatever it's going to be, you go to that right away. And then whatever happens in the market, if it goes up a lot, you'll be rebalancing. You'll be taking some of the money out of the stocks and adding to your fixed income. If the market goes down, you'll be taking some of that money out of the fixed income and adding it to your stocks. So that way you don't have to know what's going to happen in the future. All you have to know is what you're going to do in response.
Right.
Yeah, and that's
good. I feel much better now.
Yeah. Yep. And man, there's a large element of luck to everybody's lives, by the way. And whether you get started at the bottom of a correction or at the top of a peak, man, it's like tossing a quarter, and nobody really knows. But hey, what Nutriskis.com, is that still up?
Well, it works, and so does Amy's Mini Office.
Okay.
Amy'sMiniOffice.com.
Okay, Amy'sMiniOffice.com. I got to plug it because I hear the music. That means the show they're about to cut me off.
All right,
have a good weekend. All right, thanks. You've been listening to Bill Bullington right here on 1420 The Answer. Actually, I'll be here next Saturday morning. Here every Saturday morning from 11 to noon. Have a good week, everybody. Good luck and good investing.
Question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com. Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.